Everyone seems to love PepsiCo as a dividend growth stock, but I'm here today to talk about the full story, talk about some major trends I identified that you need to know about before ever investing in this company. So welcome back to the channel. If you're new here, hit that subscribe button. I'm Ken Kernen, and on today's video, let's try and get 20 likes, 20 comments, help me get towards 2,000 subscribers, and as always, make sure to comment what you thought of today's video and what you want me to talk about in future videos. So let's get on to this massive Excel sheet I've created, really going into data about PepsiCo. And in this video, I'll be covering a dividend growth stock, dividend growth investing, and I have three major questions I want to be answering. The first one, I want to figure out who is this company? What kind of revenue are they generating? What are their streams of revenue? And what kind of income are they generating? I also want to talk about the company's trend in paying out dividends. How have they been with regards to paying out dividends? Are they consistently raising their dividend and is now a good entry point? And the third biggest question I want to ask is this company's trend in being able to pay out dividends, is it good? So they've been paying out dividends really well. That's the past. I want to know about the future. Will they continue to be able to raise that dividend and make sure that this is a great dividend growth investment? So we'll be talking about PepsiCo and a little bit background on them. So their stock ticker is PEP, PEP. They're trading at around $114 right now. Their market cap is solid, $160 billion. Their PE is 21 with a forward PE of 19, so that's very reasonable. They're established in 1898 and have a starting yield of above 3%, right around 3.2%. So make sure to subscribe if you haven't already, and as a disclaimer, make sure to check this out. I really want this video to be used for educational purposes and ultimately for you to use as a beginning for identifying if this is a good investment for you. So that was the introduction. Let's talk about why DGI, why dividend growth investing. So let's talk about the pros first of all. It's an incredible stream of passive income and cash flow. Just for holding a company's stock and investing in them, you can get paid dividends on an annual, quarterly, maybe monthly basis. They will pay you for holding that stock. Eventually, the goal is to be able to cover all your living expenses with dividends, and that is absolutely possible. I'll get to that in a second. It can help provide early financial freedom, but most importantly, it provides flexibility. If you're able to cover a bunch of expenses with your dividends, you can continue to do what you want, you can continue to experiment and just have so much more flexibility in your life, which is fantastic. And then Bank of America study, hopefully you've heard of Bank of America, from 1926 for the past 90 years, or that 90-year time frame, value stocks returned 17%, while growth stocks returned 12.6%, and dividend growth investing is right in the middle, and it has, what I really like is the extra cash flow and passive income. I love that. And like with anything, there's cons associated with dividend growth investing, so it requires patience, discipline, and effort. Like anything, like any fantastic stream of income, there are some risks and there are some cons. Know about those, but really for the reward compared to the risk, I mean, it's dividend growth investing is fantastic. And so a quick fact, so if you invest $15,000 per year, that company raises their dividend at 7% each year. There's a starting yield of 3%. You reinvest those dividends for 24 years. You will eventually attain $60,000 in passive income. And that is after inflation and that is after taxes. That's incredible. And even if you stop reinvesting those dividends and just live off the dividends you built up over that time, you can start generating $100,000 in passive income after 15 years. I'll go over those calculations in the end of this video and you'll see exactly what I'm talking about. And so now you know what dividend growth investing is. Do you know who I am? Well, I'm a student in college actually, but I love soccer, I love working out. That's Scott Rogowski in this lower corner. He's host of HQ Trivia. And then that's me and my dad in Italy doing some traveling. So why do I like dividend growth investing? Especially, it's really because it provides flexibility. If I reinvest those dividends, if I pick the right companies, I'll have so much more flexibility because of because of the positive cash flow and because of that passive income generated. And if you're questioning, so why would you subscribe to this channel? Well, first, I really want to go into dividend growth investing and make sure that you understand if dividend growth investing is for you. Second thing, I focus on data and facts. Look at this huge Excel sheet I have up and ready for you. There's multiple pages of this. I really want to make decisions based on data and trends. Really understand what's going on and solely based my thoughts and my expectations off that. And lastly, you should subscribe because this content is completely free and so valuable. All right, so let's get into talking about PepsiCo. Should we even invest? So do they have a starting yield between 2 and 5%? Yes, they have 3.23%, so that's a great start. For market cap, they do have a $163 billion market cap. PE ratio is very nice. It's right at 21, so that's reasonable. Dividend growth rate is very high right now, and we'll take a look into that in just the next slide. For the payout ratio, they have a little bit high of a payout ratio, and it's continuing to increase, but it's very healthy. They are rewarding their shareholders for consecutive years of dividend increases. It is well above 10. It is actually at 46. They're a dividend aristocrat, and people love them. Do we understand the business? Yes, they're in the food and beverage industry. Incredibly easy to understand. And can it be disrupted by Amazon? Not really. So let's quickly get into who is this company, where is their sources of revenue and income. So their first source of income is North American beverages. You've heard of Pepsi, you've heard of Mountain Dew, an incredibly strong brand that is here to stay. However, currently the revenue of that stream is 21 billion out of 61 billion annually. And this should be about 30% instead of, so 34% is their total, is their percentage of revenue just from North American beverages. So they've had decreasing operating profit, increasing costs, and flat revenue. Flat revenue is concerning to me, but overall it's a ridiculously powerful brand. And one risk I want you to take note of with Pepsi is that health is absolutely becoming a more important issue. It's getting a lot more attention nowadays. With sugary sodas absolutely being a target and a concern for health benefits and health risks, that is concerning to me, and they really need to focus on improving their sales with diet sodas and pushing a healthier lifestyle, or at least adapting to that trend. Their second biggest source of revenue is Frito-Lay North America. This generates 15 billion out of 61 billion total in revenue, and that is 25% of their revenue. With regards to gross, they're increasing operating profit, they're increasing international sales, and they're doing a good job on cost reduction. Again, super powerful brands. I love Lay's chips. I mean, who doesn't? But again, a serious risk I want you to consider is, you know, they're not the most healthy things for you, and that's in the future. I do think health is going to be a more important factor. So let's talk about their current financial situation. I love going to the balance sheet for this stuff. And so what do I look for? Well, I don't want a lot of debt. Debt can absolutely crumble companies, especially when they haven't locked in very low interest rates. Interest rates going high, that's going to be a huge cost to them. And in addition, I want to see a lot of extra cash available to quickly make investments, to acquire companies, and to pay out dividends. So let's look at their balance sheet currently. They have 31 billion in current assets, 21 billion in current liabilities. I like to see a 2-to-1 ratio. It's not the end of the world, but it's okay. It's about 1.5 ratio. But with regards to total assets to total liabilities, 80 billion compared to 68 billion. That is a lot of debt, and debt is increasing year over year at a fast rate, just like assets. So it's pushing that ratio more towards 1, where I'd rather see a 2-to-1 asset to liability ratio. This is the overall balance sheet if you want to pause and take a look at that. However, let's talk about their valuation right now. So in the past 5 years, stocks returned 30% compared to 67%. I actually like seeing that. I actually like, okay, that can either be that the company has been performing well or they're actually very undervalued. So the past year return, it's been negative 2% compared to market 14%. Year to date, they've returned negative 6%, markets returned 4%, and then for the PE ratio, how much are you paying to get $1 of their earnings? It's reasonable. 21, it's below the industry, which operates at around 27, and then market operates at 25. They have a good forward PE. It's not fantastic compared to how the industry or how the market is, really. So Pepsi operates at a 19, and for their debt to equity ratio, it is high. Oof. 4, it's a 4. That's basically how are they financing their growth, and is it really debt based? And so PepsiCo is dealing with a lot more debt and financing a lot more debt to generate those earnings. So let's go on to, so we answered really who is this company. I hope you understand who is PepsiCo, their current valuation, their current financial situation. So now let's look at their trend. How have they been paying out dividends? And then their future ability to keep paying out those dividends. Because if you invested 40 years ago, oh my God, the return on this company would be amazing. And that's what we're looking for. Can they continue this trend? So let's go into that right now. So these are major trends I've been identifying. So I'm looking at the main top section is the past 10 years, what they've been averaging. The middle section is their past 5 years, so a much more recent view. And then the bottom is specifically comparing the trends. So let's quickly go through it. So in the past 10 years, on average, they've had a high dividend growth rate. So on average, they've nearly raised their dividend each year by 10%. That is fantastic. But it's almost too high. That's what I want you to be aware of. With regards to year-over-year change in net income, it's at negative 0.5%. Yikes. They're generating less profit over time, although they've been increasing gross profit and increasing revenue. This suggests to me within their sales, general, and administrative costs, they're costing themselves a lot there. Maybe that's because they're spending a lot on marketing right now because more competition is entering their space. So with regards to the past 5 years, they've had a much more healthy dividend growth rate of 8%. And then for net income, it's been slowly decreasing at negative 3.5%. Their year-over-year change in gross profit has been slowly increasing, and then their revenue overall has been decreasing in the past 5 years. Just think about this right now. If we're wanting to hold on to this company forever, and their revenue and income have actually gone down year over year on average for the past 5 years, that is concerning. That is a potentially a huge red flag. So let's compare. So we're specifically comparing the last 10 years to the last 5 years on average. Their dividend growth has been absolutely slowing down to a more healthy region, which is okay. However, net income has been decreasing, and it's been decreasing at a faster rate. Their growth of net income is slowing down, and then they're increasing their payout towards pretty high levels. I mean, their dividend payout percentage was only 54% for the past 10 years. Now it's at 62%. Eventually, if their payout percentage becomes too high compared to the net income they're generating, they're going to be really squeezed for reinvesting, for continuing to innovate their company. And they need to innovate because their sales and net income are absolutely flat, and that is a concern to me. So their dividend is becoming a greater percent of their net income, and net income has not been keeping up. Same with gross profit has been decreasing at a faster rate, and the revenue has been decreasing at a faster rate. I mean, those are huge red flags. And so for question number 3, for really going into how will this company be able to pay out dividends in the future? Will it be able to continue raising their dividend? Okay, so you have to follow. So the average net income for 10 years was around $6 million. Their average net income for 5 years was around $6 million too. So their net income growth rate has been negative for 10 years and 5 years. Okay, so if we look at, so they're raising dividends, but their net income is basically the same. Well, eventually, it seems like their dividends are going to equal the total net income they're producing, which is so dangerous because this company needs to be reinvesting all that money into making sure they're continuing to grow. So if their dividend payout continues increasing while their net income stays flat, then the number of years until the dividends paid out equals net income, which is extremely dangerous, is only 7. That means that if this trend, unless they either decrease their dividend growth rate, they increase their net income, or buy back more shares like crazy, these guys are going to run out of money. It's crazy. This huge company is going to get squeezed and run out of money to either increase their dividends or pay out that money. So that is very concerning to me. And then if we simply, because that's the average dividend they were paying out, about $3.2 million in the past 10 years, about $3.9 million in the past 5 years. However, if we start with what their dividend is currently at now, and then use the average dividend growth rate, and then we keep net income the same because it's just not changing, they only have 3 years, basically 3 years until they run out of money. So this is absolutely concerning, and a low number of years indicates, like I said, a company will need to decrease its dividend growth rate, which is not good, We want companies to have a consistent dividend growth rate. They will need to increase their net income growth rate. It's been negative. They need to fix that net income. They need to fix what's coming into the business. Their revenue is flat. Not only is their net income flat, but the quantity of units sold, their innovation is just not there. So the best option for long-term survival is to increase net income. We don't want them to reduce their dividend growth rate. We don't want them to go into just load up on debt by buying back a ton of shares. We want them to be able to increase their net income. How can they do this? They focus on international growth. Their most recent earnings report came out. It was good. They had good international growth and they're dominating those sales. They need to keep cost cutting. They're experiencing some raising costs with their North American beverages, and then they're doing a good job managing their snacks. But increasing sales, increasing revenue coming into the business is their most important aspect. So that's either going to come through marketing efforts or that's going to come through some sort of innovation. And I don't see too much innovation going to happen with their products. They just need to work on increasing market share and increasing their international presence. So overall, would I buy the company today? Well, they have a good starting yield. I like that. They have a great trend in being able to pay out dividends. Investing in this company 45 years ago, that would have been fantastic, and I would have loved that. However, I am very concerned about their growth and their future ability to pay out those dividends. They have seriously stagnated revenue. Like I said, if they kept up their dividend growth rates, their total dividends being paid out would be equal to their net income. And then literally they can't all of a sudden start paying out more dividends past their net income, or else they're going to absolutely tank the whole company. So Pepsi needs to increase their revenue. They need to increase their net income. And personally, I would not buy until I have greater assurance that they are going to dominate international sales, because I don't think a lot of innovation is coming their way with products. And as a quick reminder, make sure I really want this to be a foundation for you doing your own research, for you determining if PepsiCo is a good investment for you. And now that's the main section of the video. This is a cool calculator I put together on what I think would be an outcome. So if it's a good calculator for determining what a future yield on cost would be for investing in Pepsi. And I might link this in the description, or I'll link it in the future videos, but just looking at the past 10 years of PepsiCo, if they had a dividend growth rate of 10% and we reinvested dividends, we could earn $20,000, and we didn't reinvest dividends. We could earn $20,000 a year in passive income, and if we reinvested those dividends, we'd earn $200,000 after inflation in real income, with a dividend growth rate of 10%. I'll make a much longer video on this, but it's really cool. And then so dividend reinvestment. So if you had $15,000 and started off every year and invested that with a starting yield of 3.23% and their dividend growth rate of 6%, the actual one they use is 8.41%. You would generate almost 100,000. After tax and after inflation, you generate 100,000 with just a crazy dividend growth rate. So I really hope you enjoyed all this insight into PepsiCo and use this as a good foundation for deciding whether or not you want to invest. Thank you so much for watching today's video.